Hello and welcome. Today, we're going to discuss a topic that isn't always easy to understand, but is absolutely crucial when it comes to your personal finances: the U.S. credit score. Now, you might have heard this term before, maybe when applying for a loan or even renting an apartment, but have you ever wondered exactly how it works and why it's so important? Well, today, I'm going to break it all down for you. Whether you're a high school student, a young adult just starting out with finances, or an adult trying to understand how to improve your credit score, this video is for you. By the end of this video, you'll have a full understanding of what a credit score is, why it matters, how it's calculated, and most importantly, how you can improve yours. So, let's get started. Let's start with the basics. What is a credit score? Simply put, your credit score is a 3-digit number that reflects how financially responsible you are. It's a measure used by banks, lenders, credit card companies, and even landlords to decide how risky you are as a borrower. If you've ever borrowed money for a car, home, or credit card, your credit score has been used to determine how much interest you will pay on those loans and whether or not you'll be approved at all. In the U.S., credit scores range from 300 to 850, and generally speaking, the higher the number, the better. A score above 700 is considered good, while anything below 600 could make it more difficult for you to access credit. But it's important to understand that having a low score doesn't mean you're financially irresponsible. Life happens, and sometimes things like missed payments or unexpected events can hurt your score. For example, if you've recently lost your job or had an emergency medical expense, these situations can affect your score. But don't worry, we'll go over ways to improve it, even if it's low right now. Now that we know what a credit score is, let's talk about why it's so important. There's a saying in finance: your credit score is your financial reputation. And it's true. Your credit score impacts so many areas of your life that it's hard to ignore. Loans and mortgages. When you want to borrow money for something big, like buying a home or car, your credit score plays a huge role in whether you get approved and what your interest rate will be. For example, let's say you want to buy a car for $25,000. If you have a low credit score, you could be paying higher interest rates, meaning you end up paying more for that car over time. But if you have a good credit score, you could get a lower interest rate and save thousands of dollars over the life of the loan. Credit cards. When applying for a credit card, your credit score is one of the main things banks look at. A good score gives you access to higher credit limits, lower interest rates, and even better rewards, such as cashback or travel points. But if you have a lower score, you may only qualify for cards with high interest rates or low credit limits. Renting an apartment or house. Many landlords use your credit score to determine if they'll rent to you. If your score is low, they might worry you won't be able to pay rent on time, and they might deny your application or ask for a larger deposit. On the other hand, a good credit score shows landlords that you're a responsible tenant who pays bills on time. Insurance. In some states, insurance companies use your credit score to determine your premiums. Higher credit scores can mean lower premiums, and lower credit scores may lead to higher insurance costs. It's important to keep this in mind when you're trying to build up your score. Employment. Some employers also check your credit score, especially if you're applying for jobs in financial fields. They may want to see if you manage your finances responsibly, as your financial behavior can reflect how well you'll handle money in the workplace. All right, now let's talk about how your credit score is calculated. Understanding this can really help you figure out how to improve your score. Your score is determined by 5 factors, each with a different weight. Payment history, 35%. This is the most important factor. It makes up 35% of your credit score. Payment history includes things like whether you've paid your bills on time, any defaults, or bankruptcies. If you've missed payments or had any accounts go into collections, it will hurt your score. But don't panic. One missed payment won't ruin your score forever. The key is to make paying bills on time a habit. A helpful tip is to set up automatic payments for your bills so you never forget a payment date. Example: imagine you're applying for a credit card, and the bank sees that you missed a few payments last year. Your score might dip, but if you can show consistent on-time payments for the next year, your score will recover. Credit utilization, 30%. This factor makes up 30% of your score and refers to how much of your available credit you're using. Let's say you have a credit card with a limit of $1,000 and you've spent $500. That means your credit utilization ratio is 50%. Ideally, you want to keep this ratio below 30%. High credit utilization suggests that you're relying heavily on credit, which can lower your score. Tip: if you find yourself using a lot of credit, try to pay down your balances or request a credit limit increase to lower your utilization rate. Length of credit history, 15%. This accounts for 15% of your score. It's important to have a long history of credit use because it shows that you've managed credit responsibly over time. The longer your history, the better. Example: if you've had a credit card for 10 years, that will positively affect your score. If you open a new account, it can reduce the average age of your accounts, which can slightly lower your score temporarily. So, keep old accounts open and active if possible. Credit inquiries, 10%. This is 10% of your score and refers to how many times a lender has pulled your credit report to check your creditworthiness. When you apply for credit, it results in a hard inquiry, which can drop your score slightly. Too many hard inquiries within a short period of time may signal that you're desperate for credit, which can hurt your score. Tip: don't apply for new credit too often. If you're shopping for a mortgage or car loan, try to apply within a short time frame, usually 30 days, to minimize the impact of multiple inquiries. Credit mix, 10%. This factor makes up 10% of your score and refers to the different types of credit you have. Lenders like to see a mix of revolving credit, like credit cards, and installment loans, like car loans or mortgages. Having a healthy mix can positively affect your score, but don't open new accounts just to improve this factor. Now, let's get to the most important part. How do you improve your credit score? It's not as hard as you might think, and you don't need to have perfect credit to start improving. Here are some steps you can take. Make payments on time. This is the biggest factor. Even if you can only pay the minimum on your credit card, it's better than missing a payment altogether. Lower your credit utilization. Try to pay down your balances and avoid using too much of your available credit. Check your credit reports for errors. Sometimes there are mistakes on your credit report that can hurt your score. You're entitled to a free report from each of the 3 major credit bureaus once a year, so make sure to check them. Be patient. Credit scores take time to improve. Stay consistent, and your score will slowly increase. Example: let's say your credit score is low right now. If you start paying bills on time, reduce your credit utilization, and keep old accounts open, you'll start seeing your score rise in a few months. It won't happen overnight, but with persistence, it will improve. Here are some simple tips to improve your credit. Set up automatic payments for bills. Setting up automatic payments ensures that you never miss a payment. Whether it's your credit card bills, utilities, or other monthly payments, automation helps maintain a positive payment history, which is crucial for your score. Avoid opening multiple credit cards at once. Opening too many credit cards in a short period can lead to multiple hard inquiries on your credit report, which can lower your score. Plus, it can increase your credit utilization, even if you don't use the new credit right away. Use credit or loan calculators to compare your options. Online credit calculators can help you compare different loan and credit card options to ensure you're getting the best deal, even if your credit score isn't perfect. This can help you save money in the long run. Avoid racking up store credit or short-term loans. Using store credit or taking out short-term loans can quickly raise your credit utilization ratio. While making timely payments is important, it's better to avoid accumulating too many of these types of credit. Check your credit regularly for errors. You're entitled to 1 free credit report each year from each of the 3 major credit bureaus. Regularly checking your credit can help you spot any errors or fraudulent activities that might negatively affect your score. Diversify your credit, but only if it makes sense. Having a mix of different types of credit, such as credit cards, car loans, and mortgages, can positively affect your score. But be careful not to open unnecessary credit accounts just to improve your credit mix. Negotiate your credit limit with your lender. If you have a good payment history, consider asking your lender for a credit limit increase. A higher credit limit can help lower your credit utilization ratio, which can, in turn, improve your score. Avoid credit repair services. If you can do it yourself. Many companies offer credit repair services that promise quick fixes. However, you can usually improve your credit on your own by practicing responsible credit habits and being patient. And that's it, a complete guide to understanding and improving your credit score. Remember, your credit score is more than just a number. It's a powerful tool that can affect your financial future. Whether you're just starting to build your credit or looking to improve a low score, the tips in this video will help you get on the right track. If you have any other tips for improving your credit score, please drop them in the comments. Others will surely appreciate it. If you found this video helpful, don't forget to like, subscribe, and share it with anyone who might benefit. Thanks for watching, and I'll see you in the next video.